Hello, everybody, and welcome back. Today, my guest is Michael Hasenstab. Michael is the Chief Investment Officer and one of the portfolio managers for global macro strategies at Franklin Templeton. Welcome, Michael.
Thank you for having me.
Michael, there is this Tina quote, there is no alternative. Applied to financial market, it means that there is no alternative to equities. Do bond investors have an alternative again after the current interest rate hikes?
Well, I think it's not really about choosing one or another. In fact, I think what this last year should have taught all investors is diversification is critical. Regional diversification, global versus domestic, taking some euro exposure and non-euro exposure for euro-based investors, or dollar and non-dollar exposure. I think going between developed markets and emerging markets, all of those, I think, are the cornerstone of building a more robust portfolio. So to me, it's not just about picking bonds or equities. And of course, as rates rise, that makes the yields a bit more attractive. Of course, we have to watch about inflation trends as well. But I think it's really about building a more robust portfolio, because a lot of investors really simplify it down to just a couple asset classes. And I think that is probably limiting.
Hi there, just a 2-second break. Before we continue with the video, just make sure to subscribe to our channel now to not miss out any updates. Thank you very much and enjoy the video now.
So interest rates are rising again significantly after more than a decade. So as a bond investor, that should make you happy. Are we now seeing the big rotation into fixed income?
So it really varies region by region. If we think about the rate hike path in South America, interest rates have been rising for quite some time, and in many countries are at or close to double-digit interest rates. And this was well in advance of what the US Fed or the ECB was doing. Then there was the US, and then followed by Europe. Parts of Asia have been ahead of the Fed, parts have been lagging the Fed. So a lot of different interest rate dynamics. But I think we are starting to get into the zone where interest rates are looking different. Now, we also have to manage an outlook for inflation expectations. And so the question of timing is one that's a little uncertain, but I think certainly in some parts of the world, we're getting closer to that point where interest rates might begin to look more attractive. Now, in the very core developed markets, say in Germany or even in the US, we're probably, in our view, not quite there yet. But in some of the peripheral markets, maybe getting a little bit closer.
A question that is currently moving markets is how long will the current inflationary scenario last? And how much more can interest rate rise in the near future? So what is your take on this?
I think we have to look at different countries, because inflation in some parts of the world is really being driven by energy prices and food prices. In other parts of the world, like in the US, you're seeing it being driven by rents, you're seeing it being driven by shortages in labor. Those type of inflationary dynamics are stickier to adjust as we look throughout history or different experiences across the globe. When inflation is embedded in the labor market or is embedded in a housing market shortage, that just has greater longevity. If it's just energy or food, that can roll off in some cases a little sooner. So I think inflation, has to be watched. We did see a recent print in the US where month over month, came in a little bit better than expected at flat. But there's a lot of moving parts in there. You're seeing, rise in rent prices and fall in some of the leisure prices. And so it really is not such a, I think, simple story as one conclusion it's going up or down, but we have to drill down country by country, and there's a lot of variance there.
The actions of the central banks have also caused currency to move. So, for example, the Japanese yen and the Indian rupee have been on slide for months now. So where are investors finding that currency safe haven at the moment?
Definitely, we've seen some pretty big moves, as you mentioned, in the broad dollar index, and that's largely against the euro and the yen. Now, there's a lot of country and regional specific dynamics that are at play there, but also I think we just have seen this sort of broad-based dollar strength which in general, and again, it varies country by country, in our view, is an opportunity to diversify out of that and identify other global currencies, as we've had just such an exceptionally strong period of the dollar. Now, you can't uniformly say that against every country because there's a lot of variance, but in aggregate, this very strong dollar move is not atypical when you have a Fed rate hike cycle, but at some point, can run out of steam there. And so I think that presents an interesting opportunity for us to look at.
So first, COVID-19, supply chain shocks and skyrocketing energy prices, now the new macro political risks. So what else does this mix have in store for financial markets in the coming months?
I think we generally have more confidence that a lot of the COVID-19 supply chain disruptions will eventually be solved as China is moving towards moving away from a zero COVID, not fully there, but in that direction. I think you will see some of those easing supply chain dynamics, but there are other things at play. We're seeing a world that was once characterized by globalization and free trade be more characterized by regionalization and trade restrictions. So that affects supply chains, highly regional focus as opposed to global, looking for security of certain resources, whether it be food, whether it be certain technologies. And I think that's going to be a trend. Geopolitical, we've seen a lot of bifurcation, and a unipolar world is no longer. We see US and China very adversarial, obviously Europe, the US and Russia in a very adversarial situation. So those are complicating supply chains. I would say the one area of inflation that does concern us is in food, and food security is going to be an increasing issue, not just for this current season, but for the following seasons. And that's something we do need to watch at, both in the developed and in the developing world, how countries can handle food security issues.
In the past, there were few alternatives for bond investors other than to move up the risk ladder to generate decent returns. So what is the situation now for especially high yield bonds and high yield bond investors?
And again, it's not without risks. Anytime you're getting a higher yield, you are taking obviously greater risks. But there's two areas for us that are interesting, both because they add diversification and are able to be additive towards yields that you would get in a core developed market. And that is going global, so taking foreign currency exposures. And in many of those places, particularly in the emerging markets, I mentioned Latin America earlier, you're getting a meaningful yield pickup. Now, with that higher yield comes risk, so it's not risk-free. However, in our view, there are certain situations where you're at least getting compensated for taking those risks. And for a long time, it was difficult to find those higher yields that compensated you for that risk. So I think that's a new investment opportunity set that really the last year or so has started to unfold. And I think that's interesting. So the global space, being able to get some higher yields. And a lot of people think about just getting those higher yields in corporates, which is one way, but also sovereigns can offer some of those opportunities as well.
In which bond segments do you currently see particular investment opportunities? And how do you position yourself and your portfolios in terms of duration and quality?
Yeah, so it really varies country by country. I would say broadly, our two biggest regional allocations would be in Latin America as well as Asia. And now there's a lot of mixture of different countries in those, but broadly in Asia, we see relatively stronger growth vis-a-vis the rest of the world. Now it's not the case in every country, but the debt levels during COVID didn't balloon everywhere. Many countries actually managed those. Interest rates are moving closely on parity with the US. Again, differs country by country, but we have generally some alignment there, and large trade surpluses. And if Asia moves away from sort of this zero COVID in China, you get the reopening domestically, regionally, that can be a positive impetus. And when we look at Latin America or South America, you're seeing relatively higher interest rates, pretty strong moves upward in interest rates, and also the benefits to the terms of trade from higher commodity prices. And it's really been not just the oil, but across the hard and soft commodities. We've seen some pretty strong performance in commodity prices, and many of those countries have exposure to those commodities. And so a slightly different thesis, but also, being one of the regions we've taken a look at. Again, varies country by country, but broadly exposure to that region.
This was Michael Hasenstab from Franklin Templeton. Thank you very much, Michael, for being with us today and sharing your insights.
Thank you very much.